What is Warren Buffett's 90-10 rule? 1. The wisdom of simplicity. In the world of investing, complexity often confuses more than it clarifies. Legendary investor Warren Buffett is known for distilling financial wisdom into simple, timeless principles. One of his most practical pieces of advice is the 90-10 rule, a strategy designed for long-term wealth growth with minimal risk. 2. What is the 90-10 rule? The 90-10 rule is a portfolio allocation strategy that Buffett recommends for most investors. It suggests investing 90% of your funds in low-cost index funds, typically S&P 500 index funds, and the remaining 10% in short-term government treasuries. 3. The philosophy behind the rule. Buffett's idea stems from his belief that most investors are better off avoiding active management. Instead of chasing market trends or timing trades, he encourages a steady, low-cost approach that mirrors the overall performance of the stock market. 4. The 90% power of index funds. The bulk of the portfolio, 90%, goes into index funds, which are collections of stocks representing a market index, like the S&P 500. These funds offer instant diversification, low management costs, and performance that historically beats most actively managed portfolios over time. 5. The 10% stability through Treasurys. The remaining 10% is allocated to U.S. Treasury bills or bonds, considered among the safest investments in the world. This portion provides liquidity and protection during market downturns, acting as a financial cushion. 6. Why Buffett prefers this balance. Buffett's 90-10 rule is based on decades of market observation. He understands that, while markets fluctuate, the long-term trend of broad stock indexes like the S&P 500 is upward. The Treasury portion helps investors stay calm when the stock market temporarily declines. 7. Designed for the average investor. This rule isn't meant for professional traders or speculators. It's tailored for everyday investors who want consistent returns without constant monitoring. Buffett even suggested this formula for his own family's investments after his lifetime. 8. Keeping costs low. Low-cost index funds are at the heart of this rule. By minimizing fees and avoiding frequent trading, investors retain more of their earnings, one of Buffett's key philosophies for building wealth. 9. Long-term focus over short-term noise. The 90-10 strategy encourages patience. Instead of reacting to daily market news or price swings, it helps investors stay focused on the bigger picture, steady growth over decades rather than months. 10. The role of discipline. Success with this rule depends on discipline. Investors must resist the urge to change allocations based on emotions or market rumors. Consistency and faith in the system are what make this strategy work. 11. The historical evidence. Over long periods, diversified index funds have outperformed most mutual funds and stock pickers. Buffett's confidence in this rule comes from observing these results repeatedly through market cycles. 12. Conclusion. A blueprint for peaceful investing. Warren Buffett's 90-10 rule is not about chasing fortune, it's about financial peace of mind. By combining the growth power of index funds with the safety of treasuries, this simple approach offers a steady path to wealth, free from the chaos of short-term speculation.